Today, we delve into the captivating realm of banking, money, and cryptocurrencies. Prepare to have your perspective shattered as we uncover the 5 hidden truths that banks desperately keep under wraps. Brace yourselves, because the knowledge we're about to reveal could potentially revolutionize the entire banking system as we know it. Now, without further ado, let's embark on this exhilarating journey as we unravel the secrets behind money creation, the Federal Reserve's role, and the tantalizing world of cryptocurrencies. Get ready to challenge your preconceptions and witness the power that lies within the financial realm. This is the video they don't want you to see, so buckle up and join us as we navigate the captivating universe of money and banking. Let's jump right back into the action. Number 1. Refrain from depositing all of your money in a bank. Forget about keeping your hard-earned cash in a bank. Allow me to pose a question. What kind of interest would you accumulate by placing your savings within the confines of a financial institution? At first glance, you might expect a decent percentage, but the reality is quite different. Even renowned banks offer a meager interest rate of less than 4%. Ponder this. Your money grows by a mere 3%, while inflation surges at 8%. The true value of your wealth is steadily dwindling year after year. Instead of leaving it stagnant in a bank, you'd be better off utilizing those funds today. In just a few years, the purchasing power of your money will significantly diminish. Moreover, during periods of skyrocketing inflation, assets such as homes and stocks experience exponential growth, as we've witnessed in the past year. Banks are merely a repository for your money, not a means to make money. Number 2. Every bank has the right to create money. It may sound unbelievable, but every bank possesses the authority to conjure money out of thin air. You might be skeptical when I tell you that banks do create money, considering that the Federal Reserve is typically regarded as the sole entity with that privilege. The Federal Reserve holds the reins to currency production and operates the metaphorical printing press. However, the banking system functions in a manner that permits each bank, be it local or global, to generate money to a certain extent based on the deposits held by its customers. Imagine depositing $1,000 into Bank A. What do you think the bank will do with that money? Hoarding it serves no purpose, as they wouldn't even be able to provide you with a paltry 3% interest. Instead, the bank loans out your funds to individuals seeking to purchase cars, houses, or other assets, charging them interest rates often far higher than the meager 3 to 4% it offers you. Credit card interest rates average around 20%, which is significantly greater than what the bank pays you. The catch is that the bank won't disclose the specific recipient of your money. Whenever you check your account balance, the bank will show that your money remains intact and accessible for withdrawal. So if your money remains in the bank, where did the bank obtain the funds to lend to someone else? This practice is commonly referred to as fractional reserve banking. Banks are legally allowed to retain only 10% of the deposited amount and lend out the remaining balance. For every $1,000 you deposit, the bank creates an additional $900 and lends it to others, resulting in a total amount of $1,900. The bank essentially generates $900 out of thin air. This process is not as complicated as it may appear, given that these figures exist solely as digits within a computer system. Number 3. You can make money by borrowing from banks and investing elsewhere. Let's delve into an intriguing case from July 2012 involving Mark Zuckerberg. The renowned billionaire, then 28 years old and ranked as the 40th wealthiest person globally with an estimated net wealth of $15.6 billion, chose to finance his Palo Alto home worth $5.9 million, located just 3 miles away from Facebook's headquarters, with a 30-year mortgage. Now you might wonder, why would someone with billions of dollars opt for debt when they could easily afford to purchase multiple $6 million homes with cash alone? The answer lies in a seemingly paradoxical concept. It's free money. I understand that this notion might appear unreal at first. Why would anyone provide free money to a billionaire? After all, who gives away money without expecting something in return, aside from acts of charity? The key lies in interest rates. Remember our earlier discussion about banks offering such low returns on investment that it becomes unattractive to keep your money there as it fails to surpass inflation, resulting in a loss of value? Well, in this scenario, the tables are turned. With the inflation rate in the US ranging from 3% at the time, any borrowed money below the inflation rate can be considered free money. Zuckerberg's mortgage rate stood slightly above 1.05%. By doing the math, we can ascertain that the bank becomes the one losing out since the mortgage rate falls below inflation. You don't have to be a genius to see the benefits. Let's consider an example. Suppose you borrow $1 million at a rate of 1.05%. The average return on a savings account before the pandemic was 2.4%. And even now, it stands below 1%. But for the sake of illustration, let's stick with 2.4%. That means if you deposit those $1 million into another bank, you would make $24,000 per year, while your monthly payment to the lending bank would only be $10,500 or 1.05%. Now, imagine applying the strategy to $100 million or even $1 billion. When you can borrow money at such favorable terms, it becomes illogical to tie up your own funds when you could utilize that money for more profitable endeavors. Admittedly, this approach may not make sense when dealing with small amounts of money, as the difference would be relatively insignificant. However, when it comes to substantial sums, even playing around with a mere 1 or 2 or 0.5% could potentially yield tens or even hundreds of thousands of dollars in gains. Number 4. The richer you are, the lower the rate. It's essential to recognize that banks are not charitable organizations, but profit-driven businesses like any other. They are accountable to their shareholders, and their primary objective is to maximize profits. If their lending practices are not profitable, they won't survive. Consequently, banks are more inclined to lend money to individuals who possess substantial wealth rather than those who are financially disadvantaged. When you are a billionaire, for instance, banks can rest easy knowing the likelihood of you defaulting on your loan is minimal. Furthermore, in the rare event that you face difficulties making your monthly payments, you can readily sell a portion of your business to repay your mortgage. This significantly reduces the risk involved in lending money to you, making it an almost risk-free endeavor. In fact, this evolution of the banking system over the centuries has led to banks primarily working with the nobility or individuals who possess substantial assets capable of generating consistent income, such as land. In contrast, lending money to an average employee who may fall ill, face unemployment, or struggle to make ends meet carries significantly higher risk. While it may be easy to criticize banks for such practices, consider this. Would you feel comfortable lending money to a friend who barely earns an income, or a friend who operates a successful business? The latter option would likely be more appealing, regardless of how harsh it may sound. Therefore, if you aspire to secure lower mortgage rates, credit card rates, or better borrowing terms overall, the key is to improve your financial situation first. Banks offer preferential rates to wealthy individuals to establish strong relationships with them. This approach ensures that when these affluent individuals require larger loans in the future, they are more likely to turn to the same bank. It becomes a win-win situation. Technologies like blockchain and cryptocurrencies hold promise in reshaping the banking landscape and striving towards democratizing financial services. While they may bring about certain changes, it's important to acknowledge that banking has already undergone significant democratization, granting everyone access to financial services, contrasting starkly with the scenario a century ago. Number 5. Credit cards are banks' nuclear weapons. Consider this striking fact. 70% of Americans burdened with credit card debt acknowledge they will be unable to pay it off within a year. Let that sink in for a moment. Credit card debt is not akin to a mortgage with a modest interest rate of around 4% per year. In reality, it often reaches staggering rates of approximately 20%. If you are already struggling to meet your credit card debt obligations, it is crucial to question whether you will be in a better position to pay off an even larger debt in a few months' time. To put it plainly, a significant portion of Americans, 70% to be exact, are teetering on the brink of falling into the debt trap. More than half of those surveyed, accounting for 56%, admit to carrying credit card debt for at least a year. Sadly, For many, this burden will persist for years to come. Nearly 20% estimate that it will take them more than 3 years to fully repay their debts, while approximately 8% confess that they are uncertain when they will be able to settle their balances. This is precisely how banks often amass their fortunes, by capitalizing on people's tendency to spend without considering how they will ultimately repay their debts. Many individuals have grown accustomed to a certain standard of living and are determined to maintain it, even if it exceeds their financial means. It is precisely this behavior that prompts banks to incessantly call and entice you with offers for brand new credit cards. Don't misunderstand me. Responsible credit card usage can indeed be a valuable tool for building your credit score. However, if you are not financially responsible or lack the means to manage your debt effectively, it is crucial to avoid falling into the treacherous trap of accumulating credit card debt. If you found this video insightful and thought-provoking, I have a special treat for you: a custom playlist featuring our most popular videos on business, investing, and the stock market. It's designed to provide you with valuable knowledge that could potentially transform your life. Before you go, please take a moment to show your appreciation by giving this video a thumbs up. If you haven't subscribed to our channel yet, make sure to do so to stay updated with our latest content. Thank you for watching, and until next time, keep seeking knowledge and striving for success.